Hey everyone, welcome into another edition of the Dollar Store Boys podcast. That's right, we made it to another one. The Dollar Store Boys podcast is all about helping you with every aspect of your finances, right? Not just telling you to save, but helping you understand how to save, how to invest, how to budget, and how to grow generational wealth, learning from our experiences. We call ourselves the Dollar Store Boys because we grew our wealth by shopping at the dollar store, not being too cool to shop at the dollar store. I am your host, Dion Rabouin. I'm a retired financial journalist. I covered markets, the economy, and investing for more than a decade at places like Reuters, Yahoo Finance, and the Wall Street Journal. That experience helped me manage my personal finances, invest, and then build a couple of businesses so I could retire early. And part of what I do now is try to pass a bit of that knowledge I gained on to others. Here with my fellow dollar store boy, Justin Adams. What's going on, Justin?
Man, I'm feeling very good. I am not retired as of yet. I am very much still in the workforce. I'll put it that way. But no, you know what? It is always a pleasure to be able to jump on episode 6 of the Dollar Store Boys podcast. And always, thank you so much for just joining our show. And if you like our previous episodes, please like and subscribe. Always being able to, always a pleasure to have you on. Now, again, I'm a reporter and anchor for CBS Colorado in Denver. And I'm also a play-by-play broadcaster for Mountain West Network, Altitude Sports Entertainment, and other outlets too. And today is a very special show. Like, every show is important, but this one, when Dion said, hey, I want to do this episode, my ears were really picked up because I was like, hey, I love this subject. We're going to talk about the stock market. And look, it has been very rough so far in 2026, but we wanted to take a step back and talk about what's really going on in the stock market, okay? So this is what we're going to talk about today, okay? Number one, we'll be talking about why the market is struggling this year. We'll also explain why stock prices go up and down, and we're going to start by explaining what stocks actually are and how the stock market works. Very important, all right? Because there are a lot of people who are investing who really don't understand the basics, okay? We want to make sure that you get the basics because you want to make sure that you know what you are talking about, especially
and know what you're doing. And know what you're doing, because if you don't, you could lose a lot of money.
Or you could just trust Chat GPT and really lose a whole lot of money, right?
Yeah. Oh God. Oh, you could do that. Like, we try to keep you from doing that. That's what the Dollar Store Boys podcast is all about. Keeping you from trusting your financial future to Chat GPT.
Gotta trust those algorithms. Hopefully they get you right, all right? But Dion, let's get this thing started off right, all right? You've been an investor for a long time. You talked about just how you got into it, but break it down for us. What is a stock?
So we want to start here, right? Like, that's a great question. What is a stock? Because I think people have this idea that the stock market is just this crazy thing and you put money in and hopefully money comes out, and sometimes it goes down and it goes up. So what is a stock? A stock is literally a piece of ownership in a company. So like, the stocks that you own, you actually own a piece of those companies. So let's say you own like Microsoft, Tesla, Walmart. You are actually an owner, you own a very small percentage of those companies. So the way I like to break it down simply is like, everybody has a friend who like had a good business idea, right? Like your boy, let's say you're friends with the Dollar Store Boys, right? And we're going to start up Dollar Store Boys Sandwich, the Dollar Store Boys Sandwich Shop. And we come to you, we're like, it's the great sandwiches. And you like, man, Dion and Justin make the best sandwiches. I already know that if they open this shop up and they start selling these sandwiches, they're going to make a bunch of money. So yeah, how much money y'all need, man? Y'all need like $1,000, $10,000. Here you go. But I want to be a part owner of the company. Right. So that's something that, I'm not just going to give you the money. What I want is ownership, because I can see that y'all's business is going to grow. It's going to pick up, and I want to be a part owner. That's what you do when you invest in the stock market. You say, Microsoft, you know what? I like what's going on with that business, or, Walmart, or any of these stocks that you could buy. I'm just naming some of the big names out there in the world. But any kind of stock that you buy, what you're doing is you're saying, I want to be an owner of that company, or at least a partial owner. In exchange for money in this business, I am going to become a part owner. And that's what stock is.
So it makes a lot of sense being able to see how that goes. But okay. How about the stock market itself? Like, can you describe that to me?
Yeah. So, okay. And this is the thing, like people use the term the stock market, but it's because it's literally a market. The stock market is the market where you go to buy stocks. It's where you go to buy shares in businesses. So I mean, again, it's like, think about going to a farmer's market, right? And you see this person over here has fruit and this person's got vegetables or cheese or whatever. It's the same way. You go to the stock market and you buy shares in companies. So instead of like fruit and vegetables and cheese, over there, there's a business. I want to buy in. And instead of having to actually go to these businesses and say, hey, I want to buy in to your business, I want to become a partial owner, you just go to the stock market and those shares are for sale and anyone who wants to buy them can buy them. That's why they use the phrase publicly traded companies, because they're available to be bought and sold by the public. Now, these prices on the market, the prices are always moving. So when you go, unlike, a farmer's market where, someone might just have a price marked like $10, $20, whatever. You go in and you say, hey, how much is this? And, the stock price will be like $20, $30, $50. But if you don't move right then, the stock price will be $10.10 or $10.12. And you get to decide, I should say, every day, whether the price of a share of a small ownership stake in that company is worth the price that they're asking. So if you bought some stock previously and now you think, okay, this price is really high, I don't really know that it's going to go much higher. I really think like for what that company's doing, the value right now with a stock is probably high enough. You can sell that stock, right? On the other hand, if you think, oh, wow, this business, this dollar store boy sandwich shop it's only $10 for a share. Let me buy a bunch of those because I know, or I believe that in a year's time, or even in 6 months time, or in 10, 20 years time, again, if you're a smart investor, you're thinking 10, 20, 30 years in the future, you're saying, I believe that in the future, this piece of the company or the company itself is going to be worth a lot more money. Let me buy these shares right now. I want to buy in as an owner at this low price. And so as the company grows and becomes more and more successful, my share of the company, because I'm a partial owner, is going to be worth more and more money. And so the stock market is the place where you go to do that.
So pretty much when you think about, stock market, it's just, again, just to make it simpler, it's just like you said, go into a farmer's market. Here's all these different options that you have. And you can say, hey, I believe that this is going to be the best option for us to be able to put our money into because we believe in this company. Oh, and by the way, in order for your money to grow, we invest this money at this low end. And we believe that this company is going to continue to go and get bigger and bigger and bigger with the products that they have.
Right. And people hear the phrase buy low, sell high, and they think that's like there's an objective low or high. Buy low, sell high literally just means that, a stock could be trading at $400. Like right now, for example, Tesla is trading at $400. Well, if you think that based on what Tesla has to offer or what they do, or, Tesla is not a stock that I personally like that much, but let's say I did, right? I think Tesla is really, based on everything they're going to do and what the CEO says and, electric cars coming to the market, I think that stock is going to be worth way more in the future. Well, then $400 is low. But that's an assessment that you make as an investor. Now, I do want to pause and say, I don't buy a lot of individual stocks, and there's a reason for that, right? I mostly buy ETFs, exchange traded funds, or what they call index funds.
And Dion, before you continue on, I think it's important to point out that you are not a financial advisor.
Yes, I am not a financial advisor. I am talking about what I do, right? And you do whatever you want. I'm just trying to invest. I'm trying to educate and let folks out there know what the different options are. So again, when you're looking at individual stocks, those are individual companies you're buying shares. What I like to do as an individual, as a person, what's helped me grow my wealth is investing in index funds. And index funds are basically like, let's use the example of the farmer's market, right? Let's say I don't want to buy this broccoli or this cauliflower or, these individual vegetables. I just want to buy vegetables. Well, the stock market has these ETFs, these index funds that say, okay, you can just buy vegetables. You can just get a bag of vegetables or a bag of fruit, and it'll be a mix of all the different fruits or vegetables or cheeses or breads or whatever it is, right? So for example, I invest in QQQ, which is the NASDAQ 100. That's the 100 largest tech companies in the US. I also invest in VTI, which is the Vanguard Total Stock Index. And that's basically every US company stock. So it's over 5,000 stocks that are in VTI. And the reason I do this is because it's safer, right? So when when you buy into one company, that company, again, let's take Tesla as an example. Tesla's CEO might align himself with an unpopular president, and maybe the value of that company goes down. And maybe now people don't want to buy the cars, right? Because of this alignment that this person has. Well, that's going to hurt Tesla, but that's not necessarily going to hurt cars in general. So if I want to invest in cars, or I want to invest in electric vehicles, or I want to invest in tech, right? All of those things you could put Tesla in. That price, or the price of that overall basket of investments, isn't going to go down just because this one CEO, well, it's not going to go down that much as the individual stock is going to go down because this one CEO wants to make this one decision. So yeah, that's the other thing. Like when you buy individual stocks, that company's value might jump by 10 or 20 or 100 times because, maybe they discovered some new thing, or maybe aligning yourself with that president has really helped business because he's pumped a bunch of money into your company. I don't know. But that can increase that stock by a bunch. And so your odds of getting a big, what we call a 10 bagger or a giant return, are higher investing in individual stocks, but your downside is also much greater because that stock can go to zero, right? The S&P 500, NASDAQ, these indexes that you can invest in, they're not going to zero. And if they do, we have a big problem, much bigger than your investments here in the US. And I promise you, your investments will be the last thing on your mind if any of those go to zero.
Just curious, really quickly, if they do go to zero, what would it take for an S&P 500 to go from where it's at today to zero?
To zero. It would take the collapse of the United States economy, like the literal collapse, to take the S&P 500 zero, because that would say that every U.S. company, the 500 most significant U.S. companies, as determined by Dow Jones indices, are at zero. They're all at zero. There is no value in any business in the United States. That's what that would mean. And if there's no value in any business in the United States, the U.S. is a more than $20 trillion economy. So if we go from 20 trillion to zero, that's a problem for everyone and everything, right? But it's much easier for Tesla to go to zero. It's much easier for a Walmart, a Microsoft, or whatever. These $2 trillion companies, it's a lot less likely that they will go to zero, but any individual company can lose 50, 60, 70, 80, 90, up to 100% of its value. The odds of that happening to an index like the S&P 500 or the NASDAQ is virtually zero.
Yeah. So with that, let's go to some individual stocks that you were talking about, okay? Because you were saying that you don't invest in individual stocks, but I am curious because you see a different range of numbers. For Google, for example, it's at 300, or Microsoft's at 405. You talked about how NVIDIA, for example, it's at 183. You already mentioned Tesla's at 400. Okay, so how do all these stocks get to the price where they are before you can even own an actual stock? How does that come to happen?
That's a great question because it's something that people really don't understand. A stock is worth and a company is worth what people will pay for it. That's literally the only metric. And so if again, as stock prices start moving, you have an IPO and and the company goes public. And at that point, investors will say, okay, we're going to sell X number of shares for X price. And they kind of get to decide. But then it's all up to what people will pay. So if they put it at $20 and it comes out and people want it for 20 and they want it for 21 and they want it for 25 and they want it for 30, that price will just keep going up. And the thing that determines where the price sits is what investors are willing to pay. So when you see that number, right? Like you talked about Google, or you talked about NVIDIA, or you talk about Tesla. When investors see that number, they say, that's a good deal or that's a bad deal. And if they think it's a good deal, they'll buy it. If they think it's a bad deal, they'll sell it if they own it. or they just won't buy. And then the price has to come down to get to a level where investors say, I'm comfortable buying that. Investors are just every bit our people. They're individuals like you and me. A lot of them have a lot more money than we do.
Just a little more.
Just a little bit. But yeah, like when the public thinks the company's stock price is too high, they sell it. And, that can happen because they think the company's not as good. Maybe this company's not as good. Maybe some news came out about the company, right? Earnings reports are a big thing. That's why you see stock prices move so much after an earnings report comes out. Because earnings are once a quarter, every company will say, here's how much money we made. Here's how much product we sold. Here's how many, subscriptions or whatever we bought. Here's how much we had to pay our employees, how much we paid and, to borrow money or do any of these things. And they're required by law to release that information to the public. And the public gets to say, okay, well, we expected you to make $100 million this quarter. You only made 97. That means that your stock is not worth what I thought it was yesterday before I got these numbers. And now I'm going to sell. And usually you'll have a bunch of buying or a bunch of selling because people get to see, okay, between earnings reports, all you have is, reporting that comes out, stuff from the Wall Street Journal or Reuters or, other companies. They'll report on companies, but really you don't have any hard numbers. And so those earnings reports are so big because they tell you, here's exactly what the company did.
Wow. That is interesting to see kind of how everything is put together, just how the stock, price just comes to be. It's very, very, very interesting to see that. We have about 10 minutes in the show and just want us to move along really quick because here's the part that I'm really interested about, okay? I took your advice. I've been in the stock market ever since you got on my back, all right, to say go and get those stocks, okay? I did that. But, man, what's going on in the stock market right now, man? I don't get it.
Yeah.
Like, what is the deal? I know AI is a thing that's really driving a lot of things, but is this really what's driving the stock market right now is AI?
It really is. AI is the big theme. It's AI, but it's also what's happening in the economy, right? Like you and I have talked about folks getting laid off, right? And the number of layoffs there have been and the uncertainty that's going on. We just saw a company like Block lay off half of its entire workforce, right? Thousands of people in a mass layoff. And so as people are seeing this, they're saying, wait a second. If you look back at 2025, you look back at 2024, we thought AI was going to be this huge value creation engine. It was going to make everything so much more valuable. But now when I look, well, wait a second. If everybody's just getting laid off, if I'm not seeing this economic progress, if I'm seeing inflation at these high levels or higher than average levels, where it is right now, I don't know that I really trust these very, very high prices because in 2024, 2025, really going back to 2023, 2022, there was this story that AI was just going to supercharge the economy and the economy was going to take off and soar. And so you had companies like NVIDIA, which is now worth over $4 trillion. Back before 2020, there had never been a company worth $1 trillion. Now you have multiple companies worth over $2 trillion, $3 trillion, $4 trillion, right? NVIDIA. You have a company like Apple, and so all these companies that are now worth trillions of dollars because their stock prices have been pushed up so high. Well, now we're saying, wait a second. Does that really make sense? Are these prices justified? And it's the same thing as like, if you're going to buy a car, right? You might have thought, hey, you know what? I'll pay $55,000, $60,000, $70,000, $80,000, $90,000 for this new Hummer. Woo! I'm looking fly at a new Hummer with the rims on it. They spinning. They spin it, right? But now when I look around and I'm like, wait, I don't see too many other people driving a Hummer. And man, these gas prices are real high. And when I pull up to the club in my Hummer, people aren't looking at me the same way anymore. Maybe I'm not gonna pay 75, 85, 95,000 for this new Hummer. Maybe the Hummer is not really worth that. It's the same thing on the stock market. So when the economy starts to slow down, people start to look at companies across the economy and they say, are these prices really worth it? Is this high price for the stock really justified? And again, stock prices are all just about what people are willing to pay. And people have kind of been questioning, are these prices justified right now, given everything that's happened in the economy? And to take it one step further, is AI really going to be this growth catalyst, right? Is AI really going to send things to the moon the way that we've been assuming it has and pushing up these stock prices? So tech has really, really struggled this year, while small companies, small cap companies, indexes like the Russell 2000 and things like that, those have really outperformed as the year has gone on. And that's because those AI companies' valuations just shot up and went crazy. Their stock prices went through the roof. And now people are kind of questioning that narrative.
Is it going to normalize then? Because, again, AI is kind of driving a lot of this and tech prices and whatnot. Is it going to kind of slow down and everything?
You better hope it doesn't. You better hope it doesn't normalize.
Oh, you better hope it doesn't?
You better hope it doesn't.
Yeah. Go crazy. Go crazy.
Because because listen, here's the thing. The stock market right now, because tech companies, like we talked about, $1 trillion tech companies, there's no companies. Walmart likes to call itself a tech company and they're worth $1 trillion. We won't get into that. But outside of these big tech companies, no other companies have been driven up in value the way that they have. And so that's really what's driving the stock market. And so if that crashes and falls back to earth, you really are talking about it dragging the entire stock market down with it. And so really this lack of reality or this disbelief that people have just said, whatever, the price will keep going higher. That is what has pushed the stock market up to these levels it's at now. And the only thing that happens when it normalizes is the stock market comes down, and that's what you call a stock market crash. The other thing that's happening, though, which has been fascinating to watch on the other side of that, has been raw materials, commodities, precious metals, stuff like gold, silver, copper, and oil, all going crazy, prices rising to record highs. That's the other side of this. That's that worry about what's happening in the world. You've got the war with Iran. You've got just this crazy money printing that's been happening at the Federal Reserve. You've got the U.S. being over $1 trillion, I think $1.5 trillion in debt every single year. That's just the annual deficit, approaching $40 trillion in total debt. That really has people questioning the value of the dollar and the value of these kind of traditional investments. And so what do you want to invest in when you got things that they can't make more of? Well, there's oil in the ground, can't make more of that. There's gold, it's a naturally occurring resource, can't go make more of that, can't manufacture it, right? So I want to be invested in that. And I want to be, in something safe. And that really has driven up the value. Plus, all these AI companies need materials like silver and copper and things like that to power their data centers and all that. And so there just is a scarcity, or at least people believe there will be a scarcity, and that's pushed the value up.
Well, I'm curious because if I wanted to go and buy some gold, like first of all, are you invested in gold, silver, and natural?
Yeah.
You said it like we all should know about it. I mean, that's why I'm asking you.
Hey, listen, Playboy. You got to read the articles. You got to be out. You got to see what's out there. Got to get in these commodities, baby. I've been in gold for the past couple of years. It's performed very well for me.
See, this is what happens when you're a retired journalist, right? You read your stuff, but you retired.
Yeah,
right?
go read my stuff, man. I was talking about gold and silver back in 2024. Should have listened.
Did we already establish that it takes me at least a year for it to echo to me? Okay.
We did it. Yeah, at least a year. At least.
All right. So if I do want to invest in gold, I know it's high, right? Like you said, the prices are doing well. They are high. But if you wanted to go and invest in natural resources, where's the best places to go?
So there are a number of ETFs, like I said, exchange traded funds that you can invest in, right? So you can buy an ETF for everything. You can buy a gold ETF. You can buy a silver ETF. There's a copper ETF. It invests more in the companies that mine copper. But if you want to invest in tech, if you want to invest in airlines, if you want to invest in electric vehicles, there is an ETF out there for you. All you have to do is put in the thing that you want to invest in, an ETF, and do a search for that. And at least a couple different ETFs. They're like stocks. You trade them like stocks. So the same way I can go and open up my brokerage on Charles Schwab or Fidelity or Webull or whoever, and I can buy a share of Walmart, or I can buy a share of Kroger. I can buy an ETF that buys all the companies or a lot of the companies in the grocery space or in the retail space or gold or silver, whatever you want to invest in. That's why I really like investing in ETFs, because ETF investing allows you to invest in a theme. Like I believe in gold and silver. So I bought a bunch of gold and silver mining companies. I believe in emerging markets, right? That's those foreign countries like Brazil, China, India, South Africa. So I can buy an ETF that buys the stocks from those countries, excuse me. Right. And so that's why ETF purchases are so great and why I really like to invest that way.
Okay. So we'll definitely make sure that we do that. Make sure you write down those notes and go and invest in those ETFs. Sorry, before we run out of here, Dion.
Well, invest in ETFs if you want to invest in ETFs. Not because I told you, because we don't give investment advice. Right, Justin?
No, we're not giving you any advice, right?
No. We're not giving no advice. We're just telling you what you...
We're just letting you know that if you want to.
If you want to.
That's if you want to. Not because we told you. That's up to you.
Don't do it.
All right?
Yeah.
Before we run out of this show, man. Great show, by the way. Look, we're going to go back to what you were saying about stocks, okay? Just being a way to buy a piece of the company, okay? What companies would you recommend owning right now? Again, recommending. We're not telling you. We are recommending you to own right now.
Yeah. So listen, I don't give investment advice, as we say. So I'm not going to say what stocks anyone should buy. However, here's what I'll say as a way to think about investing, right? There's kind of two major ways that you can think about investing. One is what I call the Warren Buffett way, which is to look at individual companies and try to figure out whether that company is going to do well based on what's happening with the company and what's happening in the world, right? Like it might be a great idea to it might not be a great idea to buy a horse and buggy company when the new car just came out, right? That's, things like that. So thinking about not just the company, it might be a really great company, but if everything around them is changing, well, that's not something you want to buy. The second way is to try to figure out what sectors or what parts of the economy are going to do well. And that's how I approach investing. So when I talk about ETFs and when I talk about buying commodities and things like that, that's what I do. I say, what's happening in the world right now? What's going on and how can I profit from that? What companies are going to profit from that? And that's the thing you can do for yourself. Like a lot of people, when you're at your job, right, whatever you do, you'll probably see things like, it seems like a lot of people are buying this or a lot more people are using this. There's a way for you to invest in that, right? So I saw a couple years ago, I was like, man, real estate looks like it's doing really poorly. I'm going to invest in a reverse ETF. Now, real quick, one thing I want to say about reverse ETFs. As my man, the Notorious B.I.G. said, these are strictly for live men, not for freshmen. If you ain't got the clientele, say hell no. Reverse ETFs are very risky because when you buy reverse ETFs, there are no limits to your losses. Understand that there is no limit to your losses when you buy a reverse ETF. So have a hedging strategy. If you don't know what a hedging strategy is, don't even think about investing in a reverse ETF. But that was something I did. I invested in a reverse ETF. It's done pretty well since the real estate market has tanked. So different things like that are ways that you can express your beliefs and what's going to happen in the economy and what's going to, and how you can profit from that.
So last but not least, here's the main thing. Just as we talked about in our first show, if nothing else, there are some staples, right? You were talking about ETFs from the get-go, QQQ being a staple, right? ITOT being another one, VTI being another staple. These are just things where if you just want to take out all the busy work, again, we're not telling you what to do, just recommending.
Here's how you could do it.
Some places where you could be able to go into.
Yeah, exactly. And those are just ETFs that invest in the stock market, right? Like if you're just like, I want to be invested in the stock market, those are ways that you can do it.
Yeah. And last but not least, make sure you don't, put all your stocks in AI and say, hey, ChatGPT, what should I do?
Yeah, don't do that.
I'm just saying.
Don't do that because ChatGPT don't love you. ChatGPT ain't gonna be there when you lose all your money.
You know what it's going to do? It's going to ask you for $20 a month so you continue to take your money.
Yeah, it is. Like, yeah, bro, I told you about them stocks. I don't care if they didn't do well. Pay your bill.
Oh, man, that is the best. Hey, we're always a great time on the Dollar Store Boys podcast. We have done it again, episode number 6 in the books. And as always, thank you so much for joining us. Again, a great episode of learning how to be able to, How does the stock market work? That's what today is all about. And so if you have any other ideas or anything else that you have down there you want us to cover, please let us know in the comments section of the Dollar Store Boys podcast. Hey, our episode 5 or 5th episode doing very well, so please continue to tell your friends about it. And as always, it has been a pleasure. So look, that is our time. And once again, thank you so much for joining the Dollar Store Boys podcast. Please like and subscribe and share it to all your friends. I'm Justin Adams with my brother Dion Rabouin, and we are saying so long, and we will see you on the next episode of the Dollar Store Boys podcast.